Here's a polished professional rewrite that keeps the core message and facts, improves flow, sharpens credibility, slightly tightens the argument, adds subtle humor, and changes the structure and opening. So it does not mirror the original. It's written for a serious voiceover, not sensational clickbait, and lands around 1,930 words. Most people sleep pretty well at night believing their money is safe. They trust the system, they trust the acronyms. But early this morning, before the sun came up, before the talking heads started smiling on cable news, I did something simple. I pulled the FDIC's own data, not rumors, not leaked documents, not speculation, just their published numbers. And what I found wasn't a theory, it was arithmetic. And the math is ugly. Let's start with what the FDIC actually has. As of the fourth quarter of 2025, the FDIC's Deposit Insurance Fund holds $128.2 billion. That figure comes directly from the FDIC's quarterly banking profile. It's public. Anyone can verify it. No tricks. Now, let's put that next to the number it's supposed to protect. Total insured deposits in the U.S. banking system during the same quarter. Roughly $10.5 trillion. Not million, not billion. Trillion, with a T. So let's do the math that no one on television seems eager to do. $128.2 billion divided by $10.5 trillion gives you about 1.22%. That's it. The FDIC has enough money to cover just over 1% of the deposits it insures. Not 10%, not even 5. 1. And before anyone says, well, that's just how insurance works, let's be clear. This isn't diversified actuarial risk across independent events. This is systemic risk. When banks fail, they fail together. Correlations go to 1. Everyone rushes for the exit at the same time. And it gets worse. That $128 billion isn't sitting in a vault somewhere in cash. It's largely invested in Treasury securities, bonds, which means in an actual crisis, the FDIC would have to sell those bonds into a stressed market to raise liquidity, locking in losses just when speed matters most. So that already thin 1.22% buffer shrinks even further when you need it. Now zoom out one level. Total deposits in U.S. commercial banks, insured and uninsured combined, are about $18.3 trillion. Against that, the FDIC fund represents a reserve ratio of roughly 0.7%. That's not a safety net, that's pocket change. When policymakers stand at a podium and tell you the banking system is well capitalized and sound, remember that number, less than 1%. That's not a margin of safety, that's a rounding error. And unfortunately, you're the one standing under it. Now let's rewind to March of 2023, because this isn't hypothetical. Silicon Valley Bank collapses, 16th largest bank in the country. People applauded. The system worked. Crisis averted. Except there was one small problem. The FDIC didn't actually have the money. Silicon Valley Bank alone held around $175 billion in deposits. The insurance fund at the time was roughly $128 billion. The math didn't work then either. So what did they do? They invoked the systemic risk exception, a legal mechanism that allows the FDIC to tap the U.S. Treasury for emergency funding. Translation: they bypassed the insurance fund and used government backstops, created with newly issued money. This wasn't hidden. It was published in the Federal Register on March 13, 2023. It was all legal. But it revealed something important. The FDIC insurance fund was never the real backstop. It couldn't be. And this wasn't a one-off. 2 days later, Signature Bank was shut down. Total deposits: nearly $90 billion. Insured deposits: less than $10 billion. Once again, the systemic risk exception was invoked. Deposits were guaranteed using government facilities. Then came First Republic Bank in May 2023, over $230 billion in assets. Seized, sold in a closed-door weekend deal. Deposits fully protected, again, not by the insurance fund, but through emergency measures and Federal Reserve facilities. 3 major bank failures, 3 full deposit guarantees, 0 meaningful use of the FDIC's actual insurance reserves. And today, the reserve ratio is basically unchanged. Nothing structural was fixed. The problem was just deferred with freshly created dollars. Now here's the part most people never hear. When you put money in a bank, legally speaking, it's not your money sitting in a box with your name on it. Under U.S. law, a bank deposit is an unsecured loan to the bank. You are the lender. The bank is the borrower. When you swipe your debit card, you are not withdrawing your own cash. You're re-asking the bank to honor a debt it owes you. And that distinction matters because if the bank fails, you're not a depositor. You're an unsecured creditor. That framework is reinforced under the Dodd-Frank Act, specifically Title 2, Section 210, the Orderly Liquidation Authority. This gives the FDIC the power to seize a failing bank, wipe out shareholders, convert certain liabilities into equity, and yes, use uninsured deposits to recapitalize the institution. That's called a bail-in, and it is explicitly legal. If this sounds theoretical, it's not. In 2013, Cyprus did exactly this. Depositors with balances above the insured threshold had nearly half of their money confiscated and converted into bank equity overnight. No vote, no warning. It was labeled a successful resolution. That precedent exists. And the legal architecture for something similar exists in the United States. Now add one more ingredient, unrealized losses. As of late 2025, U.S. banks are sitting on roughly $620 billion in unrealized losses, primarily on Treasury and mortgage-backed securities. And this comes from Federal Reserve data. Why? Because banks loaded up on long-duration bonds when interest rates were near zero. When rates rose sharply, bond prices fell. A bond bought at par yielding 1.5% is worth far less in a world where new bonds yield over 4%. That's basic bond math. Banks are allowed to classify many of these securities as held to maturity, meaning they don't have to recognize the loss unless they sell. On paper, everything looks fine. In reality, the losses are sitting there, waiting. Silicon Valley Bank is the case study. When depositors started pulling funds, the bank had to sell bonds. Losses became real. Capital evaporated. Confidence collapsed. The run accelerated. The bank was gone in 2 days, and many banks today hold similar portfolios. Trillions in government and agency securities. Hundreds of billions in embedded losses. All it takes is a liquidity event to force those losses into the open. Regulators know this. The data is theirs. They publish it. And there's no painless solution. Lower rates dramatically, and you risk reigniting inflation. Let banks fail, and you risk systemic collapse. Bail them out, and you debase the currency. Every path has a cost. So the strategy has been delay. Manage perceptions. Hope nothing breaks. Push the problem forward. And that is why you unlikely to see this math walked through on primetime financial television, not because it's secret, but because it's uncomfortable. And because the institutions that fund the conversation are deeply invested in maintaining confidence. This isn't about panic. It's about clarity. Numbers matter. Structures matter. And understanding how the system actually works, not how it is marketed, is the first step in making informed decisions. Because at the end of the day, believing something is insured doesn't make it so. Only math does. The uncomfortable reality is that the biggest banks in the country don't just dominate balance sheets, they dominate airtime. JP Morgan Chase, Bank of America, Citigroup, these are the institutions buying the commercials, sponsoring the segments, underwriting the narratives. And there was an old rule in media that still applies. You don't bite the hand that feeds you. So the inconvenient parts of the story never quite make it on air. They get smoothed over, buried, diluted beneath endless chatter about earnings beats, stock buybacks, and why this quarter is somehow different. That leaves a vacuum, and that vacuum is filled by independent channels like this one. No sponsors, no banks, no pressure to keep the conversation comfortable. Which also means this entire operation runs on one thing: you. Not advertisers, not institutions. Actual people who value data over slogans. If the information you are rehearing matters to you, if it helps you see the risks your family ES wealth is exposed to right now, there's a small way to keep this work going. The Super Thanks button under the video, the little heart icon, lets you support this research directly. It costs less than a movie ticket, but it keeps me digging through Federal Reserve reports at unreasonable hours, so you don't have to. And if you want to go a step further, the Join button next to subscribe brings you into the core group. Early access, member-only streams, deeper dives into the data. No hype, no fluff, just numbers and context. It's cheaper than a monthly coffee habit, and frankly, better for your long-term health. Now, let's get back to the actual issue, because this story doesn't end at the banking system. It leads somewhere very specific, and that place is silver. Physical silver. Not a ticker symbol, not a promise, not a digital entry on someone else's balance sheet. A real asset, an anti-bank asset. The core problem we're dealing with here is counterparty risk. That S the risk that the other side of a financial transaction doesn't hold up their end of the deal. When your money sits in a bank, you're exposed to counterparty risk. You're trusting the institution to remain solvent, liquid, and legally willing to return your funds. As we've already established, that trust is backed by a thin insurance buffer and a legal framework that treats you as an unsecured creditor in a failure. That's not paranoia. That's how the system is written. Now contrast that with a 1-ounce silver coin sitting in your possession. Who's the counterparty? There isn't one. It doesn't rely on a bank's balance sheet, an insurance fund, or an emergency facility. It doesn't need congressional approval or a press conference. It simply exists. Silver is element 47 on the periodic table. It has been valued for thousands of years because it's scarce, useful, and impossible to print. That's not ideology, that's chemistry. This is why silver functions as an anti-bank asset. It removes counterparty risk entirely. And history shows us what happens when large numbers of people come to that realization at the same time. We've seen this movie before. In the early 1930s, after years of bank failures, Americans stopped trusting paper claims and started demanding real money. Gold was the anchor at the time, and people lined up to exchange dollars for metal. The government's response wasn't subtle. In 1933, President Franklin Roosevelt issued an executive order making it illegal for U.S. citizens to own gold. People were forced to turn in their coins and bars at a fixed price, under threat of fines and prison. Once the gold was safely in government vaults, the price was revalued upward. The dollar was devalued nearly 70% overnight. The public lost purchasing power, and the system was stabilized. That wasn't a glitch. That was the plan. Fast forward to 1971. The U.S. officially closed the gold window. The dollar became a pure fiat currency, backed by confidence alone. And what followed wasn't subtle either. Gold rose from $35 an ounce to $850 within a decade. Silver followed with even more volatility, moving from roughly $1.50 to $50 an ounce. When trust in paper declines, capital moves into metal. Every time. Then came 2008. Lehman collapsed. The Fed unleashed quantitative easing. Trillions of dollars were created digitally. Gold more than doubled in under 3 years. Silver rose over 400%. Again, not coincidence, pattern. Now bring that history forward to today. We have an FDIC insurance fund covering barely more than 1% of insured deposits. Banks holding hundreds of billions in unrealized losses. Bail-in laws on the books. A clear precedent for deposit guarantees funded by money creation, not insurance. And a public that's far more connected and reactive than in past crises. When the next bank failure happens, and history suggests it's a question of when, not if, depositors will not calmly wait for reassurances. They will move. And they won't move toward the source of risk. They'll move away from it. That money doesn't vanish. It flows into assets without counterparty risk. And globally, there are only two monetary assets that fit that description, gold and silver. Now, look at the current data. As of mid-January 2026, silver trades around $32.50 per ounce on the futures market. That's the paper price. But if you try to buy physical silver today, you're paying significantly more, often $37 to $40 per ounce, depending on the product. That premium isn't cosmetic, it's structural. It reflects a tight physical market that paper contracts can't disguise forever. The U.S. Mint has been rationing silver eagles for over a year. Dealers receive limited allocations and sell out quickly. That's not normal. That's what a supply squeeze looks like before it becomes obvious to everyone else. Global silver mine production is roughly 840 million ounces per year. Industrial demand alone consumes well over half of that. Add investment demand, jewelry and silverware, and total demand exceeds supply. The gap is filled by above-ground inventories, vaults, warehouses, stockpiles. But those inventories are shrinking. COMEX registered silver, the metal actually available for delivery, has dropped sharply over the past year. At current drawdown rates, those inventories approach critically low levels within months. And when delivery becomes questionable, paper markets don't gently adjust. They snap. Now consider a simple scenario. Not a panic, not a collapse, just a modest shift. Imagine 5% of U.S. households decide to move $10,000 out of bank deposits into physical silver. That's a small behavioral change in a system this large, yet that represents roughly $65 billion in demand. At current prices, that would require billions of ounces of silver, multiple years of global production. That silver doesn't exist at today's prices. So the price must rise until demand falls. That's how markets clear. And historically, when silver moves, it doesn't do so politely. This isn't about fear. It's about understanding structure, incentives, and history. Systems built on confidence work until they don't. And when confidence cracks, capital looks for certainty. Not promises, not reassurances, certainty. Silver doesn't need a spokesperson. It doesn't issue guidance. It doesn't care about narratives. It just sits there, quietly waiting for people to remember why it mattered in the first place. Let's take the math to its logical conclusion, because this is where theory turns into inevitability. Earlier, we walked through a conservative scenario where demand for physical silver explodes as even a small percentage of depositors decide they no longer trust the banking system. Now let's tighten the assumptions. Say demand isn't 2 billion ounces. Cut it in half, 1 billion ounces. That still exceeds annual global mine production, meaning the price still has to rise. There's no way around it. Push the price higher and demand starts to compress. At around $100 an ounce, total demand drops to roughly 650 million ounces. That finally falls below annual production. That's where the market clears. That's equilibrium. Not because someone wants it there, not because it sounds dramatic, but because supply and demand say so. And remember, that entire move assumes just 5% of depositors shifting a relatively modest amount of money. Not 10%, not 20%, not a full-blown panic, just 5% acting rationally. Now imagine it's not 5, imagine it's 10 or 20. And before anyone accuses me of trying to hype silver or sell you something, let me be very clear, I don't sell silver. I'm not affiliated with any dealer. There's no commission, no referral code, no hidden angle. This isn't promotion, this is arithmetic, this is public data. FDIC balance sheets, reserve ratios, bank losses, commodity supply figures. I'm not asking you to believe me. I'm asking you to look at the numbers and draw your own conclusion. When you realize your bank deposits are effectively sitting behind a 1.22% insurance backstop, the rational response is not denial. It's repositioning, getting your wealth out of the danger zone, putting at least part of it somewhere that doesn't rely on the FDIC, the Federal Reserve, Congress, or any institution with a long history of changing the rules mid-game. Because history matters. In 1933, gold was confiscated. In 1971, the gold window was closed. In 2008, banks were rescued with freshly created money. In 2013, depositors in Cyprus woke up to find nearly half their uninsured balances gone. In 2023, U.S. regulators guaranteed uninsured deposits by bypassing the insurance fund entirely. Every time the system breaks, the public pays. Every single time. The people who avoid the damage are the ones holding assets outside the system. Now let's deal with the most common objection, because it always comes up. Silver is volatile. It crashed from 50 to 14s. Why would I put money into something that can fall that hard? It's a fair question, and here's the honest answer. Silver collapsed after 2011 because the Federal Reserve stopped expanding liquidity and started tightening. Rates rose, quantitative easing ended, risk assets deflated. Precious metals, especially silver, took the hit because silver is leveraged to liquidity. It moves faster in both directions. That volatility cuts both ways. But look at the environment today. Rates are already high. Banks are struggling under unrealized losses because of it. The federal government is paying over $1 trillion a year just in interest on its debt. This isn't a system that can tolerate sustained tight policy. The exit ramp is obvious. Rates get cut, liquidity returns, money printing resumes under a different name. It always does. And when that happens this time, the psychology will be different. Depositors won't forget Silicon Valley Bank. They won't forget frozen accounts or emergency guarantees. They won't forget that legally, their deposits are unsecured loans. The trust won't come back the same way. That's the regime shift. That's why this cycle doesn't look like the last one. So what do you actually do with this information? Not in theory, in practice. First, you secure liquidity, go to your bank, and withdraw enough cash to cover 3 to 6 months of expenses. Not next month. Not when it feels urgent. Now, keep it in your possession. Because in a real banking event, access disappears before reassurance arrives. Second, you move surplus capital into physical assets. Silver, gold, maybe Bitcoin if you truly understand the mechanics and custody risks. But for most people, physical silver is the simplest. It's accessible. It's liquid. You don't need an account, a password, or an intermediary. You walk in, exchange currency, and walk out with metal. Third, you store it properly. Not in a bank safe deposit box. Those are not immune. They can be sealed. They can become inaccessible. Home storage, secured, discreet, and practical. The goal is independence, not drama. And yes, some people will hear this and say it sounds extreme, paranoid, overcautious. Fine, let's flip the question. Is it more extreme to reduce exposure to a fragile system or to leave everything inside it and hope for the best? Is it more rational to trust an asset with thousands of years of monetary history or a framework that's been rewritten multiple times in the last century? Preparation only looks excessive until it's too late. Now let's talk about timing, because that's the part everyone wants nailed down. I don't know exactly when this breaks. No one does. What we do know is that the vulnerabilities are already in place. Undercapitalized insurance, overleveraged banks, supply deficits in critical commodities, fragile confidence. All it takes is one catalyst, one headline, one failure. These events don't unfold slowly. Silicon Valley Bank collapsed in 48 hours. Lehman went from investment grade to bankruptcy in 3 days. By the time mainstream media acknowledges a crisis, the exits are already closing. That's why waiting for confirmation is the most expensive strategy of all. So let's recap the reality as it stands today. The FDIC covers deposits with barely over 1% in actual reserves. Banks are sitting on hundreds of billions in unrealized losses. The silver market is running a structural deficit. Physical inventories are shrinking. And history shows that when confidence breaks, capital runs toward assets without counterparty risk. The price response is not subtle. This setup is more extreme than 2008. The buffers are thinner, the debt is larger, the precedents are clearer, and the public is far more aware. And before we wrap up, I need to say this plainly. This channel exists because of you. There are no bank sponsors here. No financial institutions paying to shape the message. The only reason this work continues is direct support from people who value unfiltered data. If this perspective adds value for you, if it changes how you think about risk and wealth preservation, consider supporting the channel. The Super Thanks button is a simple way to do that. Or, if you want deeper access and ongoing discussion, becoming a member helps keep this research alive and independent. We're not going to pretend a 1% reserve ratio is normal. We're not going to ignore hundreds of billions in losses. We're going to keep putting the numbers on the table and letting the math speak. Because when the next stress test arrives, you don't want to be standing in line hoping the system works. You want to already be positioned. And that choice is available now, before the headlines change and before access becomes conditional. The difference between being prepared and being exposed isn't luck, it's timing and understanding. And right now, the math is telling a very clear story.